Hi everyone. Welcome again to one of my lessons for the FE exam. In this particular lesson, I'm going to go through an important topic, engineering economics. Now, this topic may not be the hardest topic. However, the mere fact that it is doable makes it very important. If you put a little time in studying this, you'll find that the problems that you get here, which could be as many as a dozen during the test, they'll be gimmes, and you should be able to get an easy set of points there for it. Anyway, if you find anything in this video that you find interesting, helpful, or just generally like, please do me a favor and subscribe to my channel. I would really appreciate it. Thank you. Engineering economics, techniques, and samples. This is the current agenda as we last left it off, plus the addition of this particular video, which represents part 8. After this, we have only 2 more parts to go. The key thing with engineering economics is, have you taken a finance course or maybe an accounting course in college, which may have covered most of these concepts? Because that is what engineering economics is drawn from, unless you took a regular engineering course in engineering economics, as I did in my undergraduate. The engineering economics covers most of the financial calculations and functions that the average engineer needs to be concerned about. The primary topic, and those with the highest likelihood of being present as FE exam problems, include time value of money, depreciation, and salvage value. Cash flow diagram. This is probably the most important thing to understand to solve these engineering economics problems. You need to come up with a diagram. It makes it much clearer in terms of how you need to lay out your calculations. Here is an example of a cash flow diagram. As you can see, and if you were to count each of the periods, the individual markings from left to right, there's 10 periods involved. The one all the way to the left is time 0. The one all the way to the right is period 10. Now this doesn't have any meaning at all unless you add in values. So in this case, we started off with a down arrow showing 8,000. Now what that represents is that you've outlaid $8,000. You've made a payment for something or purchased equipment. Usually if it's in T0, it is a purchase of equipment or an initial payment on a loan. Then each of the periods, you had a combination of 2 charges. You had a positive cash flow of $900, and what that represents is how much you made from the equipment that you may have purchased. But you also had a negative value below the line, which is $100. That's usually for something like maintenance and upkeep. So you have 10 of those going all the way out to period 10 in this example, and then at the very end you have the same 2 charges plus an additional charge. On top of the $900 positive value, another positive value of $3,500. And what that usually represents is the actual salvage value of the equipment, or resale value as used equipment, either way. Now you need to know some terminology in order to really understand how some of these problems are laid out, especially in the FE manual that's provided for you during the test. The capital P stands for present value. How much money do you have today based upon today's value of that money? The capital F stands for the future value of that money, which is what would it represent in the future, assuming some level of usually increase, but in rare cases it could be a decrease where the interest rate is going up. Obviously, if inflation is such that the interest rate actually goes negative for some reason after you've gotten a particular loan, then you might be losing money in the long run. The capital A is for annuity. An annuity is a periodic payment. Now that's either a payment that you're making or a payment that you're receiving. The capital G is a gradient. Now that's a uniform growth for each payment. What that means is it's not a fixed amount each period. The amount that's going out or coming in is growing by some percentage. It may have a base value to it, but from one period to the next, it is a much higher value. Usually each payment is double the initial payment. So the third one in the row would be double the second payment, which would be 4 times the original payment, as one example. Another case would be that it is valued only growing by a value equal to the original payment with each period. It varies depending on particular type of loan or annuity that you've actually contracted into. Now the capital P/F is a designation of two of the above terms. So we have present value and future value both in that separated by a slash, and what that means is the present value given the future value. This requires a calculation of some sort. So you're given a future value. Let's say you're giving a value of $1,000 future amount. Well, what is that worth in today's dollars depending on the interest rate that has occurred between now and then? Then you have another one, and a lot of these are the same. You have combinations of all four of the original ones that I presented here, the first four capital letters, P, F, A, and G. But there's another example. The F/G means future value given the uniform gradient value, which is a periodic payment that grows with each payment. Let's give an example of future value. Let's draw a timeline. On the left is present value, on the right is future value. I'm going to say that we have a present value of a positive amount with the up arrow all the way on the left. After the 10 periods I have listed here, how much will that be in the future? Well, I haven't given you the numbers to calculate that, but generally it will be some larger number. The actual designation for this in engineering economics is a parenthesis enclosed F/P, comma, interest rate percent, comma, number of periods. That's what that stands for that I have on the screen right now. So it's future given present, assuming a certain interest rate that's in effect during the entire period throughout all periods of this, whatever it is, for 10 periods, which is what the last term in the parentheses, the 10, stands for. Let's give another example. We'll look at the same timeline, but this time we're going to have a future debt. So there's some amount of money that will be owed in the future. That's why the negative arrow going down. What will that debt be in today's value? That's assuming if you had a debt that you didn't pay over these 10 periods, well, the debt will actually grow, or in this case, go more negative as time progresses. So in present value, it is a smaller debt, which is the blue little arrow all the way to the left. And the designation for this would be present given future. So you're starting with the future, the one on the right-hand side of the slash, and you want to calculate what the present value number of that happens to be. The interest and the period designations are the same. Now let's look at an annuity. Timeline, 10 periods, present to the left, future to the right. Each period we are receiving some amount of money. In this case, it's equal amounts. This is a standard base annuity. It's sort of like when you have a mortgage and you're the one who've given the mortgage to somebody else and they have to pay you over time a certain amount each month. This is what this represents. What does that represent in future value? It represents some larger number greater than any of the individual payments, and in actuality it comes out to a value that is only calculable if you know what the interest rate was along the way. And the designation for this would be, what is the future value given an annuity? Again, interest rate and periods in the designation. This is the way you're going to see it in the FE manual, so you got to get used to this terminology. Now, what if you have an annuity of a payback? Let's look at the timeline again. Somebody has loaned you some money, a certain amount of money, and they have outlaid some money to you. Well, you're going to have to pay that back. And you usually will do that by paying each period the same amount of money until it is fully paid back. And this is basically saying, what is the annuity given the present value of the loan? Again, percentage and periods as well in that designation. Now this is a gradient example. You started out with an initial amount of money that you outlaid as a loan to somebody, as an example. They will pay you back with a gradient calculation. And there are formulas to this. However, you have to understand that the first period, sort of like when you receive a mortgage from somebody, and hopefully you're not accepting a gradient payback schedule because that's a killer. And then you've agreed that starting in the second period, you'll start paying that one back. And then each period after that, you're going to balloon the payment a little bit bigger until the very end when you got one giant balloon payment that you have to pay back. There are a lot of forms of this. Sometimes all the individual payments along the way are the same, and then the balloon payment would be at the very end. So you got to be careful what type of mortgage you are receiving. And the designation to that is P/G, present given gradient, interest rate, and periods. The best way to solve these problems is to use interest rate tables. And starting on page 39 in the FE reference manual, start these tables for you. So on the screen, let me show version 9.5 of the FE reference manual, that particular section. So what we have here is the interest rate table. In this case, it's for an interest rate of 0.5%, and it shows in the left-hand column the periods. So it goes from 1 to, it's not linear, it's linear for a while, and then it starts to deviate once it gets past about 25 and starts going in 5s and then 10s and even larger jumps than that. But what you see across the top is assuming that this is the interest rate you want, 0.5%. Then if you want to calculate for some number of periods, let's say 5 periods, and you want to know that what is the P given F, present given future, for 5 periods at 0.5%, you're given a little factor number there. The number is 0.9754. What that number represents is a multiplier, a factor that you have to multiply the original future value by to understand what the present value will be after 5 periods, assuming that you're calculating at a period interest rate of 0.5%. And I'll show examples of this as we go. But these are all factors that you would multiply by. Another example would be, what is the future given the present for the same thing? So you have a present value, let's say $1,000. You're going to do it for 5 periods. You're going to leave it in the bank for 5 periods, and each period you're going to get 0.5%. Well, at the end of the 5 periods, you'll have $1,025.30. Now, how do I know that? You see under F given P, the F/P for 5 periods, you see a 1.0253. If I multiply that by the original amount we talked about, $1,000, it comes out to $1,025.30. Now you have these tables for all different percentage rates. So as you go through the table, it'll jump. Then you go 1.5%, 4%, 8%. It jumps up about 1 or 2% each of these tables. And we'll talk about in a couple of minutes what you have to do to deal with that if the interest rate you're looking for is between 2 values. Now, 60% of the conversions that you come across should be solvable from these tables. On the FE exam, that is. 35% of them, you'll still use the tables, but you may have to do some interpolation. The remaining 5% will actually need the actual formulas to be calculated, and some of these formulas are not trivial at all. They're on page 136 of the same version 9.5 of the manual. These are the actual formulas to convert from one to the other rather than using the table. So if you wanted to calculate future given present, what they refer to as a factor name of single payment compound amount, the symbol that we show here is the same one we should be used to by now. Future given present, percentage and number of periods. And then we have the formula. This one happens to be the simplest of the bunch. A simple thing of taking the interest rate, adding a whole number 1 to it. Remember, the interest rate's in hundreds. So if the interest rate were 4%, that means that it would be 0.04. So if you add 1 to it, that'll be 1.04. And then raising that number to a power. And the power being the number of periods involved. This is the simplest one to do. But if you get into some of these other ones, good luck, paisan. That's all I can say about it. Take a look at the uniform gradient present worth one. That's a little bit further down here. The formula is crazy. I mean, really, in terms of trying to solve this thing. That will take you forever, even with the high-end calculators that you're allowed to bring into the test. So just keep that in mind. Avoid the formulas at all costs. And that's probably the biggest message I want to give in this lesson. The formulas are the way to die a slow death when it comes to engineering economics. You will wind up wasting so much time that it's almost unimaginable. So again, use the tables as much as possible. Let me give you an example. This is going to be one that you'll be able to solve directly from the table. You purchase a machine press that will be used for 10 years. The purchase price is $15,000. The annual maintenance contract is $1,000, and the salvage value at the end will be $5,500. The effective annual interest rate is 6%, and always refer to it as that. That's how you'll see it defined, the interest rate, as the effective annual interest rate. What is the total cost over the life of the press in present value? Well, let's start by drawing a cash flow diagram and putting all the numbers into it. So we got initial outlay of $15,000. We got outlays along the way of $1,000. At the very end, we get an income of $5,500 when we salvage the thing. So what do we do to solve this? Well, we do it in steps. We do each piece separately. The first piece is the $15,000 that we actually outlaid. Well, that's already in present value, so we just put that as a start of the total. The annual maintenance is an annuity, and that must be brought into present value. So we're going to need to use, in this case, the actual dollar figure that we outlaid for the payments, and we're going to have to use the P given A, 6% at 10 period formula. Now that comes out to $1,000 times, right out of the table, is 7.3601. I won't bring the table back up. You could look that one up yourself. The result is another plus $7,360. Then we have to take the $5,500, that's the future value of the salvage, and convert it to present. And that uses the present given future 6% 10 period. So we take the 5,500, multiply it by the factor of 0.5584, again, right out of the table. That comes out to $3,071. And the total present value of it is $25,431. That would be the final answer. Now, interpolating the tables. As I mentioned earlier, sometimes you have to interpolate, especially if you are given a percentage that doesn't exist on the table. For example, if you're given 7%, well, you're going to find that tables only have 6% and 8%. But you can do what we call a linear interpolation. It is pretty much a straight line between those two numbers. So all you have to do is do the average of them. For example, if you come up with a table telling you it's 0.4203 at the first interest rate, the one lower than the one you need, and it gives you then a value of 0.4801 for the higher interest rate, so you're right in the middle of those two. So all you have to do is average the two numbers out. In this case, it's 0.4502, and that would be close enough. I mean, extremely close, if not completely there. It gets a little more complicated when you have something where you have to jump, let's say, 4 percentage rates or 5, because now you have to realize it's either 25% or only 20% of the difference with each step. So you're going to have a little more trouble calculating that out. Chances are, though, it's still going to save you time over trying to do the base formula. For example, let's use the same information from example number 1, except change the interest rate to 9%. I won't redraw the cash flow diagram on that one. However, the two multipliers would be, from step 2, you average in 6.7101 and 6.1446. That's 8% and 10% tables, and you come out with a 6.4274. For step 3 on the previous example, you average out 0.4632 and 0.3855, which results in 0.4244, and those then become your factors for those calculations. And I'll leave it up to you to work it out and see that the answer actually will be correct. Now, if you have to use the formulas, You'll find one thing about it, and this is something that a lot of people have noticed taking the FE exam. They tend to not pick the ones that you require a formula for that are the complicated formulas. For example, they may give you a term of 70 years, which just happens to be nowhere near 100 years, which is the high end of it, or you have an interest rate that's greater than 20%, and that's also outside the range of the tables. And in both of those cases, it's probably going to be fruitless trying to interpolate. You're outside the bounds of the table, and now it becomes somewhat non-linear, and you don't want to deal with that. So you're going to have to use the formula. However, you should also consider a question like that as one you save for the end of the test, because that might be one you may want to potentially guess at, or at least logically interpolate at the end of the test. The question itself, that is. However, if you have to use the formula, as I said a minute ago, chances are it's one of the easier formulas. So at least look up and see which formula you would need to use before you make the decision on this one. If it's one of the easier formulas, then give it a shot. You probably can get that done in time. If not, then I would say put it off. Example number 3, this time using a formula. You decide to pass some of what you've acquired in your life down to your great-grandchildren. So you create an account that offers a rate of 29% as long as it is not withdrawn for 75 years, and you deposit $100 into that account. How much will those descendants be able to withdraw at maturity? This requires the formula. Let's use the future given present. It's the 29% interest rate for 75 years. We're going to use the simple formula of parend 1 plus interest rate, so it'll be 1.29 raised to the 75th power. That you can plug right into the calculator and come up with the answer, and amazingly, you will be passing along to your descendants $196,829,091.60. Wow. Now that's a good gift. Now for depreciation. There are two basic methods to calculate depreciation. They include straight line depreciation and what's called Modified Accelerated Cost Recovery System, more commonly known as MACRS. In straight line depreciation, the value that you depreciate and able to claim on your taxes will be the same every year during the life of the whatever it is that you bought. The calculation is directly calculated from the formula D sub j equals C minus S sub n divided by n, as shown on the screen. So we have the D sub j is the annual depreciation amount that you can claim. The C is the original purchase cost. The S sub n is the salvage value. And the n is the service life of the piece of equipment in years. For example, a truck will be purchased for $60,000 with an expected usable life of 16 years and a final salvage value of $12,000. What is the annual depreciation that you can claim on this one? Well, using straight line depreciation formula, you can almost do this one in your head. It becomes 60,000 minus 12,000, or 48,000, divided by 16, which ends with a result of $3,000 per year that you can depreciate this, assuming you're depreciating it over 16 years. MACRS. Now this is really the way you're going to most likely see it, because the U.S. Internal Revenue Service today, this is all they allow except for some extremely rare cases. Depending on the type of asset, it may be able to achieve full depreciation in 3, 5, 7, or 10 years. Now this is under continual legislation modification, so this could change at any time. The depreciation is calculated from a table rather than a formula, and this is shown in the next slide, with the rows being the applicable recovery period and the columns being each of the years during the planned depreciation. The number that's shown within the body of the table are the factors that must be multiplied by the original purchase price, and the salvage value, this is an important consideration, is not considered, since that would become income in the year it was received using the MACRS method. Here's the table. And as I said, the left-hand column shows the depreciation year, And then there's the 4 possible periods that you could have for a particular piece of equipment. It's usually determined by the expected lifespan of the equipment. Computer equipment tends to be allowed in 3 years. Some larger computer equipment may be 5 years, but large machinery would most likely be 7 or even more likely 10 years before they can be fully depreciated. What you see here is a bunch of numbers that are inside each of the cells. You go to the particular method that you're using, which method being which years of depreciation that's allowed. You pull that factor out, you multiply it by the original purchase price, and that's the amount that you can actually declare in a given year. Now, an important note to this is that when you're using MACRS depreciation, the book value of the item is calculated by whatever you have not declared yet in depreciation. So let's say that something were depreciated for 4 years out of a 7-year cycle. Well, if you look at those numbers real quickly, in the first 4 years, most of it will be depreciated. So the actual book value will probably be at the most 25 or 30% in my guess, just looking at those numbers. Also notice that the very first row under year 1, that's the year you originally did the purchase. So that's the amount that you can declare from the initial purchase in that year. Now, for example, a company purchases a new CNC system for $120,000. The current interest rate at that time is 5%, and the expected life of this equipment is 12 years. Assuming MACRS depreciation over a 7-year period, if the company is sold after 5 years of the purchase of that equipment, so 5 years have gone by since they purchased it and the company has now been sold, chances are they want to know what the book value of the equipment is, and that'll be included in the purchase agreement. Well, what is that book value in this example? The solution. This one gets a little bit more complicated. First of all, the second sentence in the problem contains completely extraneous information, and this is done quite often on the FE exam, to be honest. You need to start by calculating the total appreciation taken on that equipment up to that point that the company is sold. So it was sold in its 6th year, right? If you calculate it out, 5 years later you're now in your 6th year. So we'll take the first 5 values of the 10-year MACRS. We add up those factors, 10 plus 18 plus 14.4, etc., and it comes up with a total of 63.14. We then take that factor and we multiply it by the original purchase price of $120,000. That comes out with $75,768. That is the amount that we have depreciated it in the years up to, or at least the years that we reported taxes on up to the purchase of the company. So to calculate the book value, we find the difference between that and the original purchase price, which comes out to $44,232. With that, we get ready for the next lesson. The next lesson will be ethics and licensing. It's actually a very important lesson. A lot of people get hung up on these, and they shouldn't. These are pretty easy topics to just read and study some basic facts about. So that'll be part 9, and it'll lead off in the next chapter of this series. Thank you. Well, that concludes part 8 of my FE exam preparatory program. I hope you enjoyed it. And if you did, please do me a favor and subscribe to the channel. It would really help the channel grow, and we'd be able to produce higher quality videos for you going forward. Just click on the little head here, follow along. That's all you have to do. Thanks again.